The Intelligent Investor was written by Benjamin Graham, a well-known economist and investor. First published in 1949, this book has remained one of the most respected guides on investing. Graham was a professor and mentor to Warren Buffett, one of the most successful investors in history. His ideas have influenced many people who want to understand how to make smart financial decisions and build long-term wealth. The book remains relevant today because it teaches fundamental principles that do not change with market trends. The book was written during a time when the stock market was still recovering from the Great Depression and World War II. Many people had lost money, and investing seemed risky. Graham wanted to teach ordinary people how to invest wisely and protect their money from losses. He believed that investing should not be based on luck or emotions, but on careful analysis and logic. This approach is called value investing, which focuses on finding stocks that are priced lower than their true worth. By following this method, investors can reduce risks and increase their chances of long-term success. The ideas presented in the book have become a foundation for many modern investment strategies and continue to shape financial markets today. One of the main ideas in the book is that investors should be careful and patient. Graham explains that the stock market moves up and down because of emotions like fear and greed. Instead of following the crowd, he advises investors to focus on facts and think long-term. He introduces the idea of Mr. Market, an imaginary person who offers to buy or sell stocks every day. Sometimes Mr. Market is too optimistic and offers high prices, and other times he is too pessimistic and offers low prices. The intelligent investor does not follow Mr. Market blindly, but makes decisions based on the real value of a company. This concept helps investors understand that they should not let short-term price movements control their decisions, reinforcing the importance of rational thinking over emotional reactions. Another important idea in the book is the difference between investing and speculating. Graham says that investors look for good businesses that will grow over time, while speculators try to make quick money by guessing how prices will change. He warns that speculation is risky and can lead to big losses. To be a successful investor, a person must focus on companies that have strong financial health and stable earnings. This requires a deep understanding of financial statements, market trends, and industry performance. He emphasizes that intelligent investing is about long-term results and not about making a profit in a short period through market speculation. Graham also talks about the importance of having a margin of safety. This means buying stocks at a price lower than their actual worth. If something goes wrong, the investor will not lose too much money because they bought the stock at a discount. This principle helps protect investors from making bad decisions and suffering heavy losses. The margin of safety also allows investors to remain confident during market downturns, knowing that they purchased assets at reasonable prices. This simple but powerful concept is one of the key takeaways from the book and has been widely adopted by successful investors around the world. The book also explains the difference between defensive and enterprising investors. Defensive investors want to avoid risks and prefer safe investments like bonds or well-known companies. They do not spend much time analyzing stocks and prefer a simple strategy. They might choose index funds or blue-chip stocks that have a history of stability and growth. On the other hand, enterprising investors are willing to do more research and take some risks to get higher returns. They study companies carefully and look for opportunities that others might miss. Enterprising investors spend time analyzing financial reports, understanding market conditions, and evaluating businesses in depth before making investment decisions. These two approaches provide different paths for investors based on their risk tolerance and willingness to commit time to research. Graham emphasizes that investing requires discipline and a strong mindset. People should not panic when prices go down or become too excited when prices go up. Instead, they should stay calm and follow their strategy. He also suggests diversifying investments to reduce risk. Instead of putting all their money into one stock, investors should spread it across different companies and industries. This way, if one investment does poorly, the others can balance the losses. Diversification is one of the key strategies that protect investors from unexpected changes in the market, and this strategy remains relevant for investors today. Throughout the book, Graham provides many practical tips on how to analyze stocks. He teaches investors how to read financial statements and understand important numbers like earnings, dividends, and book value. He encourages people to focus on companies with strong financial positions and good management. He also warns against trusting financial experts too much because no one can predict the market perfectly. Instead, he advises investors to do their own research and think independently. He highlights that financial news and predictions are often influenced by emotions, and investors should always focus on data and long-term trends instead of market noise. By developing strong analytical skills, investors can make informed decisions and avoid the common mistakes that lead to losses. The Intelligent Investor also discusses the role of inflation and how it affects investments. Graham explains that inflation reduces the value of money over time. This means that if people keep their money in cash or low-interest accounts, they might lose purchasing power. He suggests that investors should have a mix of stocks and bonds to protect themselves from inflation. Stocks have the potential to grow, while bonds provide stability. By balancing these assets, investors can create a portfolio that performs well in different economic conditions. Graham highlights the importance of keeping up with economic changes and adjusting investment strategies accordingly. Graham also introduces the idea of dollar-cost averaging. This strategy involves investing a fixed amount of money at regular intervals, no matter what happens in the market. By doing this, investors avoid making emotional decisions and benefit from buying stocks at different prices over time. This helps reduce risk and ensures that they do not buy too much when prices are high. Dollar-cost averaging is a useful strategy for investors who want to stay invested in the market without worrying about short-term price fluctuations. It provides a way to build wealth steadily while minimizing risk. The book teaches that investors should not try to beat the market or get rich quickly. Instead, they should focus on slow and steady growth. Graham believes that the best investors are patient and disciplined. He also reminds readers that no investment is completely safe, but by following his principles, they can increase their chances of success. He warns against emotional investing, chasing trends, and reacting to short-term events, as these behaviors often lead to losses. Long-term thinking and a methodical approach to investing are the hallmarks of intelligent investors. Graham also stresses the importance of continuous learning. Investors should always improve their knowledge of the market, study economic trends, and stay updated with financial news. By doing so, they can make informed decisions and avoid common mistakes. Reading financial reports, studying successful companies, and understanding industry trends are essential habits for long-term success. He advises that learning from past market events can help investors prepare for future uncertainties. Over the years, many investors have followed Graham's advice and achieved great results. His ideas remain relevant even today because they focus on timeless principles rather than short-term trends.